Canadian banks continued to slash interest rates last month, but there is news on the horizon. Bond yields are starting to increase, and that could mean that the slashes, at least temporarily, are coming to an end. And this is largely due to the news out of the US, and specifically Jerome Powell and the Fed, who suggested that Americans can maybe not expect that interest rates are going to come down as fast as they previously thought. And considering that US inflation is coming down faster than Canadian inflation, does that mean that perhaps we won't see interest rates coming down as fast in Canada either? Well, the truth is nobody really knows. But what I am going to give you in this video is what the mortgage rates are today. And keep in mind that when we talk about the mortgage rates today, we can typically hold these for up to 4 months. So if interest rates do go up, well, you can hold these so that you have these interest rates available to you 4 months down the road. So if you're looking to get a mortgage and you're thinking that you may be entering the market in the next 3 months to 4 months, make sure that you're getting your mortgage application in now with either your mortgage broker or your banker, or if you want Mortgage 360 to help you, we're more than happy to do that. But I have to, just call a spade here. It's 2024. Do we really go to our bank for our mortgages anymore? Especially when there's other options out there. And I'll show you those in a minute. So without further ado, I'm going to jump in and I'm going to show you what the rates are for February of 2024. And first of all, I want to start by showing you exactly what I was talking about with respect to government bond yields. You can see that they were quite low in mid-January. And as we started to hit the end of January here, they started to come up a little bit. And again, this is largely due to debt fears in the US, as well as Jerome Powell saying the inflation fight may not be over yet and suggesting that interest rates may not come down. So that has led bond yields, which is what 5-year fixed mortgages are based off of, or all fixed rate mortgages for that matter, are based off of, to go up. So we have seen slashing in interest rates. There's still some room with respect to the amount of margin that they have in their mortgages. So they may not start increasing interest rates because of this. But if interest rates continue to go up the way that they are at the moment, we could see interest rates start to stall or come up in the coming weeks. So watch that for February. By the way, if you want to figure out what direction interest rates are going to go at any given time, the best way to do that is by looking up the Canada 5-year government bond yield. And based on what's happening with that bond yield, it typically is an indicator of where fixed rates are going to go at least a day or two down the road or a week down the road. Now, if interest rates are going up, you'll see the changes happen a lot faster. If interest rates are going down, it'll take a little bit longer for the banks to reflect that. But for the most part, you can use this graph to sort of see what's happening in real time in the bond market and subsequently in the fixed rate mortgage market. So without further ado, I'm going to get to the actual interest rates. Of course, we always start with the 5-year fixed full feature mortgages. Now, a couple of things you should know about these types of mortgages. First is that these are the full feature best products available in the industry, which often means, by the way, that they don't come from banks. In fact, none of the rates I'm going to quote here are coming from a big bank. The reason why is because these mortgages are the combination of the best rate and the best features, which also means they have the lowest penalties, which could be important if interest rates do come down somewhere down the road. So we typically, with respect to 5-year fixed mortgages, avoid big banks. If somebody wants a variable rate or a line of credit, absolutely, we'll send clients there. But for the most part, we take the better mortgages from companies like First National, MCAP, CMLS, that don't have big brand names that they can skate on or reputations that they can skate on, and that actually have to have better mortgages in order to compete with the big banks. And like I said, they really do have better mortgages from the perspective of, for the most part, all else is equal, except for the one thing, and that's the most important thing, which is the penalty, which means that if you have to pay out the mortgage to maybe get a lower rate or because you want to move or because you need to change something, well, you aren't going to give the bank a whole ton of money. So I'm going to show you what these rates are, starting with insured mortgages, down quite substantially from last month. We're now looking at 5.09 for an insured 5-year fixed mortgage, which is a great rate. And then when we start getting to greater than 35% down, you're starting to look at similar sorts of rates. And then as you start to put less money down and get towards that 20% down threshold, which is where mortgages are no longer insured, you start to see interest rates go up. Now, why is it more expensive for a 20% down mortgage than it is for an insured mortgage? Well, the reason's simple. That is because 20% down is where the bank carries the most risk. because they no longer have the insurance, which creates basically zero risk for them, and they are taking on all the risks. So if the market drops by 20 or 30%, like we saw it do last year, basically those mortgages are now in a place where the amount of the mortgage could be equivalent to the purchase price of the property. So as a result, we find ourselves in this situation where the bank could be underwater and they're taking on that risk. So that's why they're pricing it higher. And when you start to get to 35% down, well, that's where typically you won't see that big of a drop in real estate values. So the bank is very much protected when you get to 35% down. Even if markets go down, people still have equity that they probably don't want to walk away from. And then getting into uninsurable refinances, properties over $1 million, 30-year amortizations. These are all mortgages that are deemed more higher risk. Well, that's where you start to get into higher rates. They're now priced at 5.59%. But as you can see, all of the rates on 5-year fixed mortgages between the beginning of January and today have pretty much gone down substantially. And there's continued opportunity for that to happen depending on what happens with the bond market yields. But only time will tell what it looks like 3 to 4 months down the road. And that's why it's important that you go and you get your rate hold if you're looking to get into the market so that you can secure these lower rates just in case they do start to go up. Now, moving on to 5-year variable rates, there's pretty much no changes here. Prime is still 7.2%. We haven't seen the Bank of Canada lower the overnight lending rate, which would lead to prime rate coming down. So these are all pretty much the same. Prime minus 0.9 on an insured mortgage. So you're looking at 6.3%. Now, relative to a 5-year fixed, do you really want to take a mortgage at 6.3% when you can get a 5-year fixed at 5.09? There's a lot of people who are taking variable rates right now because they think that the market is going to come down and the rates are going to come down. Well, I'm not necessarily sure that that is the best idea, because if interest rates don't come down, and keep in mind, they're going to have to come down almost 5 times for you to be break even. Well, if they don't come down, you could end up paying substantially more for those variable rate mortgages. So I'm not sure that's the best strategy. In fact, the exact same strategy that we've had over the years, which is take the lowest rate you can get at the time you get the mortgage, continues to be the strategy we suggest. I'm a little bit worried about some of the people who are picking variable because they think they have a crystal ball and the Bank of Canada is saying interest rates are going to come down. Well, keep in mind what they said in 2020 when interest rates were supposed to stay low for a very, very, very long time, and they didn't. So don't use those forecasts to make your decision. Use good, sound decision making, which is, what do we know right now? What do we know for sure? What we know for sure right now is that a fixed rate is substantially cheaper than a variable rate. So getting to 30% down, looking at prime minus 0.75, and I'll let you pause on the video here if you want to pause on it and take a look at these as you start to put less and less down, or as you get into mortgages over $1 million or 30-year amortizations or refinancing, obviously the price goes up or the discount reduces. Now, moving into discount mortgages, I'm going to pull these up. I'm not going to go through them one by one, but I am going to talk about the differences between the discount mortgages and the full feature mortgages. And that is primarily that just like anything else in life, you get what you pay for. So when you start seeing the super low rates advertised online, keep in mind that there is a reason why there are super low interest rates there. And that is because you're often giving something up. And it's not always, but most commonly, the ability to pay out the mortgage and switch to a different lender at some point in the future. So in other words, unless you sell the property, you have to hold the mortgage till term. Now, I don't know about you, but it's my belief that if I borrow money from somebody, I shouldn't be forced to continue to borrow the money. If I want to pay it back, I should be able to do it. But in a lot of cases, when you're getting an ultra low interest rate, that's what they're taking away from you. And where that becomes problematic is when you start to get into a situation where interest rates go down, you want to pay out the mortgage, go and get a rate at a different lender that's lower. You lose the ability to do that because you've got the inability to pay the mortgage out, which could end up costing you tens of thousands of dollars because you've got that mortgage that had the flexibility taken away. So the difference in price here is typically around a cup of coffee per week, depending on how big the mortgage is. It might be a Tim Hortons or a Starbucks, but at the end of the day, it's literally a cup of coffee a week, maybe for you and your spouse, maybe for you. Like I said, depends on how big the mortgage is. But do you really want to give up a cup of coffee a week to get that lower interest rate when it could mean not having the ability to get a lower rate down the road? And I'll give you a quick story about that. I had a friend years ago got diagnosed with prostate cancer, got told by the doctors in Calgary here that he had no other options, wasn't going to be able to do anything, and that he should just put his affairs in order and expect that he had basically 5 years left to live. Now, this was 2013, and he ended up going down to the States, going to the Mayo Clinic. He ended up talking to a surgeon there, and the surgeon said, you know what? I operate on this all the time, can clean it out, shouldn't be a problem. You should be able to live a very healthy life. And the thing was, it was expensive. It cost him $80,000 to have that surgery down there. And this is always the point I bring up when I talk about discount mortgages, is if he would have had a discount mortgage, he wouldn't have been able to refinance his property and he wouldn't have been able to pay for the surgery. But because he had a mortgage that had flexibility, he was able to go in, refinance, do what he needed to do, and it saved his life. Now, not everyone's going to have that same sort of story, but I tell you the story because it shows how important it is to have flexibility, especially when you're making the biggest financial decision of your life. Oh, and by the way, if you want to know more about discount mortgages, I've got 2 options for you. I've got my Rate Secrets course that tells you everything you need to know about getting a mortgage, including how to negotiate with a broker and a bank if you still are stuck in the 90s and you want to deal with them directly, and also gives you all the information you need on discount mortgages versus full featured mortgages and what to watch out for. Basically, we'll give you everything you need to make sure that you don't get screwed. Or you can go to mortgagesecrets.ca and get my book for free. All you have to do is pay for the shipping, and it's got a lot of that information, although not in as much detail because it's a book and it can't be super up to date. It has to be kind of generic in the information and the timing of the information, but you can go there and get pretty similar information as well, and that's totally free. I want to make sure that everybody has access to the information. That's why we have the YouTube channel. That's why it says Thrive and Give up there. It's because my why is to inspire people to thrive and to give back. So if you can't afford the course, get the book. And all I ask is when you save $5, $10, $15, $20,000 on your mortgage, make sure you maybe make a donation and give a little to somebody. And then specifically with variable rates, we're really cautious of discount mortgages with variable rates because if you ever need to lock in, you lose all of your negotiating power. You can't go elsewhere because the lender can pretty much dictate what your lock-in rate is going to be. And you can't say, well, screw you, I'm going to pay the penalty and leave, because they've got you over the barrel. So having the flexibility, having the negotiating power is important. And it's definitely something you want to pay attention to when you're choosing your mortgage. And a great broker will give you the differences between a discount mortgage and the differences between a full feature mortgage, and give you the information you need in order to make that decision for yourself. By the way, if you want to know more about what's happening with the Bank of Canada and some of their recent decisions, make sure you check out this video right here.